Hello and welcome to the Week in Forex, brought to you by UFXBank. Today we'll take a look at some of the past week's market highlights. The global equity markets were positive last week and the dollar resumed its sell-off. Perhaps the biggest numbers though to print last week came on Friday in the US, with unemployment hitting a 26-year high of 10.2%, when market consensus was looking for a 9.9%. Other important news this weekend is the G20 meeting of finance ministers. For a closer look at the markets, we're joined by our foreign exchange analyst, Martin Smith. Welcome, Martin.
Okay.
So let's start with the big news of the 10.2% unemployment rate in the US. What are the ramifications here?
Well, although shocking to see in print, the rumours have been circulating that the rate would come in over 10%. But no one was going to put that number down as a forecast. You can see by trader reaction, in fact, that there was little volatility after the release, as if it was already priced in.
So what do you expect to see in the markets as a result of one of the largest global markets seemingly struggling to find firm ground?
Well, the immediate implication is that the US dollar will weaken further. There were a number of positive economic releases this past week. There were confirmations of a bottom and a return to growth, at least in the manufacturing sector.
It just seems quite strange how, on the one hand, we have signs of growth, and then on the other hand, there's a struggling consumer market.
Well, unemployment, of course, is always viewed as the lagging indicator. What this means is the last action a company takes when things appear to be turning round is the hiring of full-time workers. Therefore, your recovery might already be underway before you see unemployment numbers start to drop. Additionally, and very importantly for traders, it's a signal that risk-taking can continue because the US recovery has not halted, because in fact in the midst of a slow, steady climb.
So if I understand you correctly, then the dollar can continue to weaken as long as people are willing to trade on risk?
Oh, that's correct. It's a confirmation of how the markets have been trading for the last 8 months. In fact, it's textbook trading. You borrow the cheapest, safest currency in order to invest in the higher yielding currency. This is what the markets refer to as the carry trade. If traders sense risk, they will cover their positions, which drives up the price on the cheaper currency for as long as risk is perceived in the markets.
So how will a potentially weaker dollar sit with all the members of the G20 after all the central bank comments that we've heard in advance of this week's meeting?
Well, that's a great question, because we saw the dollar strengthen after central bankers started issuing a call for strong dollar policies several weeks ago. However, after the US unemployment figures came out, there seems thus far to be an understanding that quantitative easing cannot cease until the US consumer is ready to play a bigger role in the recovery. The concern would be that shutting off financing could make things significantly worse for an economy in such a delicate situation. If the US economy were to double dip, well, that would bring down the larger global economies once again.
So what do you foresee for the currency markets in light of all of this?
The currency markets are back at similar handles as they were 3 weeks ago. They're teetering at breaking through resistance. You have a Swiss franc once again looking for dollar parity, the pound near the top of its 8-month resistance levels, the euro primed to again break through 150. The key for now is the Forex to equity market correlation. If the equity markets are ready to resume risk-taking and continue their advance, we'll see the dollar continue to weaken. On the other hand, if equity markets take the rest of the year off, which is not uncommon at this point in the year, then the Forex markets will stay range-bound through the end of December.
A very interesting insight. Thank you very much, Martin. And thank you for watching. Remember, visit us at ufxbank.com for simple, safe, secure trading.